President Trump signed the big, beautiful bill into law on the 4th of July, and I just want to focus on the overtime provision in this video because a lot of people are still confused about which part of overtime pay is supposed to be tax-free and how does this income phase-out range really work? Is the maximum income limit at $150,000 and $300,000 for married couples, or does the deduction phase out at those income thresholds? And before you go celebrating and blowing your next paycheck on a new fishing boat or whatever, let me break down why this is not the free money loophole it sounds like. Because no taxes on overtime is not entirely tax free. So here's the headline. Starting January 1st, 2025 and running through December 31st, 2028, you do not have to pay federal income tax on your overtime pay. And if you're single, you can deduct up to $12,500 of your overtime pay from your federal taxable income. And if you're married and filing taxes jointly, you can deduct up to $25,000. But some people are already confused about this because they think they can get that $12,500 or $25,000 right back into their wallet. And that's not how a tax deduction works. A tax deduction reduces your taxable income. So if your taxable income is $100,000 and your OT deduction is $25,000, then your taxable income becomes $75,000. And if your marginal tax rate is at 22%, the most you'll get back into your pocket from the federal income tax is $5,500 because you need to multiply $25,000 by 22%, which is the marginal tax rate. And if this were a tax credit, then that $25,000 could directly reduce your tax bill. And that makes sense so far, right? So if your marginal tax rate were 24%, then you would get $3,000 back on your tax return because it's $12,500 multiplied by 24%. You have to understand the differences between a tax credit and a tax deduction. And the overtime rule comes with an income limit, and the new law indicates when your $12,500 or $25,000 threshold starts to phase out. So let's say you make an extra $15,000 in overtime for the year 2025. If you are married, you get to knock off all $15,000 from your federal income taxes as long as you're under the income limit of $300,000. And if you're single, that income limit is $150,000 before your overtime tax deduction starts to phase out. So they cut $100 of your deduction for every $1,000 over the limit. Let me explain how the formula works. So for single individuals, the income phase out begins at $150,000 in modified adjusted gross income. So there would be no overtime deduction after $275,000 in income. And the difference between that phase out range is about $125,000. So if you make $200,000 in 2025, then you can calculate the difference in the phase out range. So how you do that is going to be $200,000 minus $150,000, and that's going to be $50,000 into the income phase out range. So you want to divide $50,000 by $125,000, and that's going to give you 0.4 or 40% into the income phase out range. So what you want to do is looking at that total $12,500 that you could deduct and multiply that by 40%. So you're going to lose $5,000 from that tax deduction. So $12,500 minus $5,000 is $7,500. So the prorated deduction that you're going to get making $200,000 a year is going to be $7,500. Let me give you another example. Let's say you are married and filing taxes jointly. So the phase out begins at $300,000 in modified adjusted gross income. So you do not get any deductions when your income hits $550,000. So the difference between that is going to be $250,000. So let's say you make $400,000 in 2025. Let's calculate the differences in the phase out range. So what you do is $400,000 minus $300,000, and that's going to give you $100,000 into the income phase out range. So what you want to do is divide $100,000 by $250,000, and that's also going to give you 0.4 or 40% into the income phase out range. So you want to look at the total overtime deduction, which is $25,000 for married couples, and multiply that by 40%, and that's going to give you $10,000. And $25,000 minus $10,000 is going to be $15,000 in prorated deduction. So making $400,000 a year in 2025, the most you can deduct is going to be $15,000. So again, the amount you can deduct will be reduced by $100 for each $1,000 you exceed in that income threshold. And you cannot deduct it at all if you're making more than $275,000 as a single individual or $550,000 as a married couple. And if you're in between $150,000 and $275,000 as a single individual, or in between $300,000 and $550,000 as a married couple, then you'll need to use the formula I just showed you to calculate the partial deduction. And if you're still not clear about this, you can always schedule a 60-minute consultation with me by visiting firecc.com/consultation to discuss your financial situation. And here's the part where I show you what's taxed and what's not taxed. And let's break it down with a basic example. And let's say your regular hourly rate is $30 an hour. And under the Fair Labor Standards Act, or FLSA, employees who work more than 40 hours in a work week are generally paid time and a half for those overtime hours, unless they're specifically exempt. And overtime is time and a half, right? So it's $45 an hour. Now, here's the part most folks misunderstand. It's only the premium part. The extra $15 per hour is exempt from federal income tax. So you still pay federal income tax on the $30 base salary or the hourly rate. It's only the difference between your regular and overtime rate that gets the break. And that is the part nobody seems to be saying out loud. But here's where it gets tricky. If you are what they call exempt, you could work 60 hours a week and still get paid the same salary. And we're talking about managers, certain professionals, outside salespeople. Basically, if you're making decisions that affect the company or you're in a specialized role, there is a good chance you're exempt. And then there are some jobs where the rules are just different. Take truckers, for example, or firefighters. They might not get overtime until they hit 60 hours because of the nature of their work. Or if you're in a certain seasonal industries, the threshold might be different. It's not as simple as work over 40 hours, get overtime pay. Your job type, your salary level, and even your industry can all affect whether you're qualified for overtime in the first place. Let's look at a concrete example of how this plays out with your overall income. So imagine you make $100,000 in 2025, and let's break that down to $80,000 in base salary and $20,000 for your overtime pay. Now, here's what's happening to that overtime money. And this is where people are getting it wrong. You're not paying federal income tax on that $20,000. That part is true, but you're still paying state income tax if your state has one. Also, you're still paying FICA taxes, which includes your Medicare and Social Security. And here's the part that really gets people. Again, you are still paying federal income tax on the regular hourly rate because this whole thing only applies to the premium rate. So when you see that $20,000 in overtime pay for in this example, make absolutely sure that it is pure premium pay that is being considered for this deduction and not bundled up with your base pay in a way that obscures the benefit. And your employer should be clearly reporting qualified overtime compensation on your W-2 form comes January. And the IRS is not going to let you slide if you try to get cute with the numbers. And here's the part you really need to remember, and that is not a permanent provision. It is set to expire on December 31st, 2028, which is about a month before Trump leaves office. So this provision is explicitly tied to a certain time frame. Whether it gets extended, modified, or completely scrapped after that depends on future legislation and the political climate at that time. So do not plan your long-term finances assuming this will be around forever. Just see this window of opportunity wisely if it applies to you. So what does this all mean for you? Well, if you're working overtime and you qualify for this deduction, it is definitely better than nothing. But do not go thinking you just won the lottery. You're still paying a good chunk of taxes on that overtime money, just not as much as you would have before. And what I want you to do is take a hard look at your pay stub, figure out exactly how much overtime you're working and what your effective tax rate is after all the taxes you're still paying. Then you can make some real decisions about whether it makes sense to pick up more overtime hours or not. And here's something that I want you to remember from someone who's been doing pretty much all of this for a living with all the clients. And just do not make big life decisions based on temporary tax provisions. This thing expires in 2028 and there's no guarantee it gets renewed. So plan accordingly. If you found this breakdown helpful and you want me to dive into other provisions of this bill, let me know in the comments down below. There's a lot more to unpack here and I will be happy to break it down for you. And this has been another beast of a video and I hope you got a lot out of it.